We got some numbers out this week. I want to run through and tell you how it's going to impact the housing market, if at all. Some new information that is a bit speculative, but I think is worth mentioning. So let me dive right in. First of all, inflation is at 3% in June, which beat expectations a little bit. Again, the number they're trying to get to is 2%. Okay, so to move from 3% to 2% doesn't seem like a lot, but it's actually a whole lot. I'm going to talk about that in more detail in a second. But as far as the expectation of what that number was supposed to be, 3% was a little bit lower than expected, which is good for markets because markets really like when you beat expectations. Um, Core CPI, though, which excludes food and energy, so you take out food and energy, um, and that's at 4.8%. Okay, so their target again is 2% on CPI, Consumer Price Index. You have to understand something though. The reason why that's the target is because wage growth, value of the dollar, all these things. If if we're at a 2% inflation rate, then there's minimum damage to the overall economy and to the consumer. We know that the value of the dollar goes down over time because of the removal from the dollar off the gold standard. But I want to say something quickly about the printing of money because what hasn't happened yet is all the $500 billion that the government's going to inject into the economy as a result of the Inflation Reduction Act um, hasn't hit the economy yet, but it's going to in the near future. And we haven't even begun to see the impact of that. Just to give you an idea, okay, when we went into the last market correction of 2008, in October of 2008, there was approximately 813 billion US dollars in circulation. Okay, as compared to kind of when that market cycle started, let's say November of 2001, there was $621 billion in circulation. So between 2001 2007, roughly 200 billion added to circulation, which is about 30%. Okay, and we know that if everything else is the same, the more dollars in circulation, the lower value each of those dollars has. So to contrast that, at the start of um, the recession in 2008 October, there was $813 billion in circulation. Today, or in June, there was 2.34 trillion in circulation. That's 188% more dollars in circulation. So the government has printed more money in the last decade than they had printed since the establishment of our government, essentially. And you just cannot add that much paper money to the marketplace without significantly diminishing the value of that money and increasing the commensurate cost of the things that that money buys. And housing is one of those things, clearly. Um, so just let that sink in for a second because I think it's worth noting, and I don't think it's showing up in any of these numbers yet. What does all of this mean for the housing market and the future of the housing market? Well, it means a couple things. First of all, it solidifies that we can pretty much count on another two federal rate hikes to the federal funds rate before the end of the year. People are saying somewhere between a total of 50 to 75 basis point increase over and above where we're at currently. That's already kind of baked into the market. Mortgage rates spiked, the 10-year treasury spiked off of the latest jobs report, which was a good jobs report. Good in the sense that it's a healthy job market. People are employed. The unemployment numbers are not falling at the rate that the Federal Reserve wants to see. And, in terms of how the market receives that information, it pretty much says, well, in order to get to where Jay Powell and the Federal Reserve need us to be from an overall economic standpoint, they're definitely going to do another couple rate hikes, and that's why we saw rates shoot up earlier this week, and they're starting to work their way back down. So going back, what does this say about the housing market? It says that rates are going to stay higher for longer, likely, you know, well into the first quarter of 2024 before we can expect even the possibility of a course reversal and seeing rates start to come back down. Um, so, uh, not likely before the first quarter of next year to see a real spike in demand because those interest rates, those elevated interest rates, are helping to keep demand at a lower rate than they otherwise would be, simply because people either can't qualify at the current interest rates, don't want to leave their lower mortgage rate for a higher mortgage rate. There's a variety of reasons, but let's just agree on the fact that demand is down because of interest rates. Okay. Which again, that's what the Fed is trying to do here, trying to slow the growth of the economy. Housing is a big part of the economy. So, runaway prices in the housing market, not awesome in the eyes of the Federal Reserve. And for obvious reasons, affordability matters, right? Um, but, the more you start to fiddle with things when it comes to a free market, sometimes you can do a lot more harm than good, as we saw back in 2008, 2007. So, where am I going with all this? So, higher rates for longer, keeping demand at bay, per se. Um, and so, we talked a lot about supply and demand and the relation between the two, and how supply is very limited. So, even with the lower demand, we also have lower supply, which is helping to keep prices uh, elevated. And so we saw, a dip in prices in December, and they've slowly been climbing, climbing, climbing ever since. We saw again prices continue to climb in June. And so, if demand and supply stay the same, that should continue. Prices will have some modest growth between now and the end of the year. Um, so here's what I did mention, though, in terms of new information that I heard somebody. I'm not going to mention the name, in one of their analysis videos put out. I think it's interesting. I think it's also very assumptive. I don't know that there's a lot of data to support what he's saying, but it's worth noting. Back in the 2000, basically starting in 2012, all the way up through last year, we saw a lot of institutional buyers in the market. Companies like America Homes for Rent might be one that you've heard of. Basically, real estate being used as an investment vehicle for big time money. They come in, they buy residential real estate because they can get very low fixed rate debt on those properties, and make money off of the rent. And we've definitely seen a pullback in those institutional buyers. They've stopped, or very very slowed, very much slowed, in some cases stopped buying. Um, I don't know that they own enough of the inventory here in the Raleigh area to really substantially impact prices. But just say theoretically, okay, they wake up tomorrow and they decide we want to get rid of 30 or 40% of our lowest performing assets, put them on the market tomorrow. Um, that could very well bring, thousands of units to the market overnight, basically, which no doubt would have an effect, but it would be a blip. Okay, because once that inventory gets absorbed, you can't they there's a limit to how much they can inject, because they only own so much, and they're not going to dispose of all of their assets, because in the course of doing so, the price they would basically kill the price of their own asset. They're not stupid enough to do that. So they may start to gradually dispose of some of a portion of their portfolio, but they're not going to do it all at once. Um, and so, even if that were to happen, we would certainly see an increase in supply. And this is what I've been talking about time and time again. Where is the supply going to come from? It can only come from a couple of places. Either they have to build it, people have to list their homes, which again they're not going to do in droves right now until rates start to come down. Um, so this is one of the kind of wild card areas, I guess I would say, uh, as other investment opportunities open up with the higher interest rates, treasuries, things like that. Might some of these institutional buyers get out of a portion of their portfolio? Sure, that could possibly happen. Um, will it impact the prices of real estate long term? I can't speak for the rest of the country, but here in Raleigh, no, it won't. It would be a blip. It might be a little bit of a buying opportunity in a short term, but then it would very quickly recover if everything else stayed the same. The second possible source of supply, and this is kind of interesting, you probably either bought or know somebody who did buy a short term rental in the last 2 to 3 years. Um, that market kind of exploded, especially at the coast. But this whole like Airbnb trend, it certainly picked up a lot of steam over the last few years. So I'm definitely seeing a saturation in the market amongst Airbnb properties. Some of you watching this, if you bought a house at the beach, let's say in the last 2 years, and it's on Airbnb, you've most likely this year seen a higher vacancy rate, or it's harder to rent those properties out. Maybe you've had to cut your price a little bit to attract travelers to your property. That's just because there's more available because everybody got into that market at one time. So let's say something else happens in the economy that causes people on a larger scale to need that money back. Those are vacant homes, more or less. Nobody's living there long term, so it's very easy. It's a lot easier to dispose of those properties than it would be a property that you're living in. So that's another potential for supply that is out there. There's a percentage of properties that are owned and rented on a short-term basis that if somebody needed to get out of, and we're talking about mainly mom and pop type 1 and 2, properties. We're not talking about the institutions that own big groups of these properties like they do in the long-term rental space. But if enough of these sellers got into the market at the same time, again, could force prices down for the short term because of that supply injection without a commensurate increase in demand that would only theoretically be caused by lower interest rates. Okay. So, it's anybody's guess. This is an impossible thing to predict. If I could predict with 100% certainty, um, I'd be in a much different position than I am right now. And, I think anybody can say that. If we had a crystal ball, we wouldn't be in this economic situation as a country. So what we have to do is try to look at the signals, read between the tea leaves, and look for these outlier things that kind of could happen, might happen, could have an impact. But um, overall, right now, still, prices are going to remain stable and probably increase in our area through the rest of the year, barring anything drastically unforeseen. So you can expect mortgage rates to stay high. You can expect prices to go up. If you're in the market now to move, then there's really no point to wait because the prices of what you're going to buy is most likely just going to continue to go up. So if you've been sitting on the sidelines for the last couple of years, I feel sorry for you. I feel sorry for you because I think you've missed a big opportunity by thinking prices were going to come down. Don't repeat the same mistake. Um, Go ahead if it benefits you and your family, buy and wait for the rates to come down because that probably will happen, and it's just a matter of time before it does. What happened first quarter, second quarter, third quarter, or fourth quarter of next year is the big question. So as long as you can afford the monthly payment, um, get into the house now because prices are likely to just continue to rise, which will continue to raise your monthly payment. So that's all I got. And I'll be back as soon as we have more news. Take care. Bye bye.